This is James Altucher here at the Street.com TV, here with little-known hedge fund manager Jim Cramer. So Jim, if you had to open up your first brokerage account today, say you had a couple $1,000, $10,000, what stock, and you only wanted to buy one stock, what would you buy?
I would still be completely sure about the Sears situation.
Okay.
Because the greatest mistake I have of my investing career was that I was told to buy Berkshire Hathaway in 1982, 1981 for $200 by a man who really knew a lot, Leon Cooperman, who came right to me and suggested I read the annual and do it. And I was arrogant about it and didn't believe him and felt that the stock had already doubled. And that it's so Sears-like, it's scary. I had dinner with Eddie Lampert last Monday. And Eddie remains one of my friends. He's been my friend since 1982. And I feel strongly that if anyone, I'm not saying he is, but if anyone could be Warren Buffett, now I know because of Stock Picker, we've got these other fields. Brookfield seems very interesting. Markle seems very interesting. But I have the blessed experience of being firsthand with Eddie, and he and I had the exact same record the year that I retired over the 10-year period, 15-year period that I was in the game. And he was in it shorter than I was. And I just feel like that he is emblematic of what I really want in a manager. So I'm picking that one.
Well, okay, let's go back to 1982 for a second. What did Leon Cooperman see, and what did you see about Berkshire that were...
Great mind. That's all I saw was great mind, because I read the annual, and I was like completely flummoxed why that group of businesses would be any good at all.
So you saw like a furniture business, a chocolate business, and you were...
Yeah, I mean, you know, when I read it, and I just said, well, I really like Lee Cooperman. He's really smart. But he's very off base here because it's a very difficult to analyze security that doesn't seem to have a lot going for it in long-term secular growth. And that, to me, it looked like the businesses were dead-end businesses. And the guy was, I knew no reason why he would be such a great investment mind, although he did write a good annual. That's Sears. Sears seems like a very dead-end business.
Well, you know, it's interesting because the pros and cons of Sears almost have nothing to do with the business itself.
Absolutely.
So the pros are all the same pros that Leon Cooperman told you.
And that's my reservation for leaving the stock. Now, people, I have been involved in a lot of controversial stocks. I'm involved with NYX now. That's a controversial stock. Here's how you approach controversial stocks. You either like them and buy them on the way down because you've made up your mind and you keep checking the story and its story's good, or you cut and run. When I have cut and run, whether it be on Alcan or Ingersoll Rand or Bausch & Lomb, it's been disastrous. In all my cut and run situations, the same thing has occurred. I read my email. I take counsel of my fears. I see the stock go down, and people just say the stock tells me that I'm wrong. Foster Wheeler, when it went from 50 to 32, there I dug my heels in because I knew management very well. But it's always the same. NYX is a terrific template. I mean, everyone's decided it's horrible, but I haven't. And Euronext seems very good for me. So I welcome the stock's decline. I wish Sears would go back to 140 so I could buy more. It doesn't seem to want to. But I would tell you that to all the people who read Stock Picker and read Real Money and all our sites, that they may not understand the way big money is really made in the country. And the way it's made is to have conviction. And conviction is sorely lacking, and fear is completely rampant on many parts of the sites that I follow. And that's wrong. And people have to understand that one of the things that makes a great investor is that he or she has done the work and is impervious to the catcalls.
Well, you know, what's interesting about your Sears call is that if I had to pick my one stock that I would buy, it's related to your pick in that I would actually pick Citigroup right now because Eddie Lampert is piling into it, and because he's raising more money to pile more into it, I feel.
In short, I think you're 100% right. I think that you're going to see that play out. And I think that you're going to be, there was an article this weekend, John Neff in Barron's, who's very, very good. He's not as good as Archie McAllister, who's the best in that roundtable, because these guys are the least promotional. But was talking about the value of Citi. I mean, and I think that people, are talking about breaking up Citi. Citi just needs to have a good manager, and it can get a multiple. It doesn't. I also was reading this weekend about another ActionAlertsPlus.com named Goldman and why it doesn't get a premium multiple, and it's because they said because its earnings are too variable. And that's precisely untrue. Its earnings are very not variable. I read a lot in the papers, and I always think, wow, if I were younger, I would be selling a lot of stuff.
Well,
but I've just, I'm too crusty.
People probably say that about Goldman just because Lloyd Blankfein was from the trader's background. So it's an easy thing to conjure up for a story.
What I always look at is, okay, let's take Wells Fargo. Okay, Wells Fargo has a 14 multiple. It's really not that great a company. Stock has done very little. It's a very competitive business, the banking business. You have people who are willing to lose money, and the yield curve's bad. Goldman doesn't care about the yield curve and doesn't have branch banking, and yet it has a 10 multiple. What I'm saying is that whole perception is wrong. Now, before you deride that, I had said that the oil service stocks, that for a year and a half, I said their multiple was wrong. For a year and a half, I felt out of sync. I don't want to say ridiculed. No one ridiculed me for it, but I mean, Transocean was at 72, and I just said, well, this is just a major, major mistake by the market. The infrastructure stocks, I just said, look, the long-term analysis of the oil business, the mineral business, means we need more infrastructure companies, and they've been starved since the early 80s. Foster Wheeler. And people are only realizing now that what was cyclical is now secular. It's also considered to be a terrible thing to ever say that a cyclical is secular. But yet that's how the big money's been made. And what you do is you look at the long-term contracts. It's very clear that the oil service companies are locked in 3-4 years visibility. The infrastructure stocks, 3-4 years visibility. And when it comes to the brokers, I see the companies on a very big growth path overseas that could lead to multiple years of visibility.
Well, it also begs the question, and let's take Citigroup as an example again. If Eddie Lampert's piling in, do we need to do any more research?
No.
Does the retail investor need to study it?
That's the stock picker model. See, it's like Third Point, which I stumbled on through Stock Picker. It's like Third Point's done a huge amount of work, and I don't have the time to do their high-quality work. Yeah. But they're certainly willing to have other people tag along because they make it very, they were very public about PDLI, which is one I got from Stock Picker. And it's one of the reasons why I regard the site as being my research department.
Well, I have an interesting story actually about how we started Stock Picker. I'm going to save it for another video. Okay. But this is James Altucher and Jim Cramer. Thanks.